Okay, so you made a little money in the market this year.
Mhm.
Maybe you got some dividends. Maybe you sold a stock, saw a nice little profit.
Feels good, right?
Yeah, you see those numbers go up in your account. Feels pretty good. But then, tax season rolls around.
And suddenly, a chunk of that profit seems to,
Yeah.
vanish.
Exactly. There's a tax bill, and you're thinking, why? When exactly did I trigger that? When did I owe the IRS money?
Right. It's not just about making the money.
No.
It's about the specific actions, the specific events that the IRS looks at and says, okay, that right there, that's taxable.
That's the moment.
That's the moment. And, a lot of investors, they focus on the outcome, the profit, the income. They kind of overlook the trigger.
The trigger, yeah.
The U.S. tax system, especially for investors, it's really built around these specific things called taxable events.
Mm-hmm.
Understanding them is just foundational.
Sounds like it.
It really is. It's the difference between, getting blindsided by your tax bill and actually being able to anticipate it, to understand why you owe what you owe.
And that right there is exactly what this deep dive is all about.
Yeah.
We're trying to cut through some of that complexity. We're looking at the rules, laid out in official sources like IRS publications. Publication 550 is a big one on investment income and expenses.
Yep. Pub 550. Essential reading, if a bit dry.
Yeah, definitely dry. But also solid financial education materials. Our mission here is really to pull out the most common, the most important taxable events you need to know about as a U.S. investor.
Kind of like giving you a clearer map.
Right, exactly. A clearer map of this whole tax landscape. So you can see not just the profit you made, but also, the tax shadow that kind of follows it.
Think of it like getting a user manual. A user manual for the tax side of your investment moves.
Yeah, I like that.
We're just going to highlight those specific moments, those actions that actually create a tax liability. Moving beyond just the general idea of, I made money.
Okay, let's unpack this then. When we talk about the main ways you trigger a tax event with your investments, it seems like it generally boils down to two big categories. Is that right?
That's a great way to put it. Two main buckets.
Yeah, what are they?
You either, one, receive income from just holding an investment while you still own it.
Okay.
Or two, you realize a gain by selling or, otherwise getting rid of an investment.
And selling or disposing.
Yep. That covers, the vast majority of situations for most individual investors.
All right, so let's start with that first category then. Receiving income while you still own the asset. What falls in there?
Primarily, we're talking interest and dividends.
Interest and dividends, okay. So basic interest income. We kind of know this from savings accounts, right? The bank sends you that form, 1099 INT, the interest is taxable.
Right.
But it's probably a bit more nuanced in the investment world, especially with things like bonds.
Oh, absolutely. Much more nuanced. So when you own bonds, could be corporate bonds, could be government bonds, the interest payments you actually receive, or even just the ones credited to your account.
Even if you don't see the cash yet.
Even if it's just credited,
Yeah.
that's generally taxable income in the year you receive it, or it's credited. That payment or that credit, that is the specific taxable event. And yeah, it's usually reported on Form 1099 INT.
Okay. Now, you mentioned government bonds. Are there exceptions there? I feel like I've heard municipal bonds are different.
Yes, and that's a really significant one. Interest you get from most state and local government bonds, muni bonds, if they're used to finance, regular governmental operations.
But building schools or roads.
Exactly, things like that. That interest is typically exempt from federal income tax.
Okay, exempt. A big
That's
difference.
Huge difference. So receiving interest from, say, a Ford Motor Company bond, that's a federal taxable event. Receiving interest from a qualifying New York City general obligation bond, generally not a federal taxable event.
Wow.
And sometimes those state bonds might also be exempt from state and local taxes too, if you live in that specific state.
Yeah.
So the source of the bond, who issued it, matters a whole lot.
Definitely something to check. Okay, what about U.S. savings bonds? Things like Series EE or Series I bonds. I've heard they have kind of unique tax rules.
They absolutely do. And they're actually a great example of how when you choose to recognize income can actually defer the taxable event itself.
Defer it. How?
So for Series E and Series I bonds, the ones issued after 1989, you, as a cash method taxpayer, which most individuals are,
Right.
you basically get a choice about how to handle the interest.
Okay, interesting. How does that work?
Well, the interest on these bonds, it doesn't get paid out to you regularly like a corporate bond coupon. It just accrues, it builds up over time, and increases the bond's redemption value. So method one for reporting is you just defer it. You don't report that accrued interest until one of three things happens, whichever comes first.
Okay, what are the three?
Either the bond matures, they can go up to 30 years, or you cash it in before maturity, or you somehow dispose of it, like give it away or sell it.
So the taxable event gets pushed way out, potentially decades.
Potentially decades, yeah. Under Method 1, the actual act of cashing the bond in, or the moment it matures if you hold it that long, that's the taxable event.
And all the interest that built up over all those years?
Becomes taxable income in that single year. Bam.
Okay, that could be a big hit if you weren't expecting it. What's the alternative? Method 2.
Method 2 is you elect to report the interest income each year as it accrues and increases the bond's value.
So you pay tax along the way.
Exactly. In this case, the taxable event happens annually based on that increase in value that gets reported to you. A smaller hit each year, potentially.
And once you pick a method, are you stuck with it?
Generally, yeah. If you choose Method 2, the annual reporting, you have to report the interest that way for all the savings bonds you own and any you buy later on, unless you get special permission from the IRS to change, which isn't always easy.
Okay, what if you started with Method 1, deferring the tax for years, and then you decide, you know what, I want to switch to Method 2 and start paying annually?
Well, that decision itself triggers a pretty significant taxable event.
Oh, really? Just changing the method?
Yep. In the year you make that switch, that election to go from Method 1 to Method 2, you have to report all the interest that is built up on all your savings bonds up to that point that you haven't already reported.
Whoa. So all that deferred interest comes due at once?
All at once. That could be a really substantial amount of income hitting your tax return in 1 year.
Oof, yeah. That could definitely be a surprise tax bill if you weren't ready for it. It really shows that even just changing your accounting method can be a major taxable event itself.
It absolutely can.
What about transferring these bonds? Like if I give one to my kid?
Good question. Transferring ownership, even as a gift, can also trigger that deferred interest. If you've been using Method 1, deferring the interest, and you transfer the bonds to someone else and give up all your ownership rights, you generally have to report all the interest that accrued up to that transfer date as income in that year.
So the act of giving it away triggers the tax for me.
For you, the one giving it away, usually yes. Now, there are some exceptions, like transferring to your spouse or sometimes to certain types of trusts where you're still considered the owner for tax purposes.
Okay. And if someone inherits them, like if the bonds transfer because the owner passed away?
Then the tax generally follows the bonds. The recipient, the estate, or the beneficiary usually reports that previously untaxed interest when they cash the bonds in or when the bonds mature, or they might be able to elect to continue deferring under certain rules.
Okay, so with savings bonds, the taxable event isn't just getting a check. It could be cashing it in, maturity, changing how you report it, or even just transferring ownership. Lots of triggers there.
Very true. It's more complex than people often realize.
What about bonds bought at a discount? I hear terms like original issue discount or OID thrown around.
Ah, yes. OID, another crucial concept and another example where you can have a taxable event without actually receiving any cash at that moment.
Okay, how does OID work?
OID happens when a bond or some other debt instrument is originally issued at a price less than its stated redemption price at maturity. That difference between the issue price and the face value is the original issue discount.
So it's sold cheap initially.
Right. And that discount, that OID, it's essentially treated as extra interest that accrues over the life of the bond.
And the tax trigger for this OID, it's different from just getting a regular bond interest payment, isn't it?
Fundamentally different, yes. For most debt instruments that have OID, you must include a portion of that OID in your gross income each year that you own the instrument.
Every year, even though you don't get the cash until the bond matures, maybe years later.
Even though you don't get the cash, that annual inclusion, that's the taxable event for OID. The IRS requires it. They report this amount to you, typically on Form 1099 OID.
Why do they do that?
It basically prevents investors from deferring all that interest income, that economic gain, until the very end when the bond matures. It forces you to recognize it as it economically accrues.
So, okay, let me see if I get this. With a regular bond, getting the actual coupon payment is the trigger.
Right.
With an OID bond, it's more like the passage of time itself, the accrual of that discount value each year. That's the trigger, even without a cash payment.
You got it. The act of that discount accruing, sort of mathematically over the bond's life, is considered the income event by the tax code.
Huh. What happens to my cost basis in the bond then?
Good point. Your basis in the bond actually gets increased by the amount of OID you report as income each year.
Ah, okay. So you don't get taxed on it again when you sell.
Exactly. It prevents double taxation on that OID amount when you eventually sell the bond or it matures.
Okay, that makes sense. Now, what if I buy a bond, but not when it's first issued? Like, I buy it on the secondary market and I get it at a discount. Is that also OID that gets taxed annually?
Probably not. That sounds more like what's called market discount.
Market discount. Different from OID.
Yes. Market discount happens when you buy a bond for less than its face value after it's already been issued. Usually happens because, say, market interest rates have gone up since the bond was issued, making older bonds with lower rates less attractive unless sold at a discount. Or maybe the issuer's credit quality dropped.
Okay, so it's a discount created by market conditions, not the original issuance. How is that taxed?
It also generally accrues over the life of the bond, like OID. But the key difference is, typically you don't have to report market discount as income each year.
Oh, so you can defer it.
Usually, yes. The taxable event for market discount is generally deferred until you sell a bond, exchange it, or start receiving principal payments on it.
Okay, so market discount usually defers the taxable event until you get rid of the bond, but OID forces you to pay tax annually.
That's the standard treatment, yes. Now, there's a wrinkle. You can make an election to include market discount in your income currently as it accrues, similar to how OID works.
You can choose to pay tax earlier. Why would someone do that?
It might simplify things in some complex situations or maybe align with other tax planning. But the point is, if you make that election, then yes, the annual accrual does become the taxable event for market discount too.
But if you don't make that election?
If you don't elect current inclusion, the taxable event for the market discount is pushed out until you sell or the bond matures. And here's a key point. When that accrued market discount is finally taxed, it's generally taxed as ordinary income, not as a capital gain.
Ordinary income, even though I got it from selling a bond.
Yes, that's a potential tax trap many people miss. OID is generally ordinary income too, but market discount tax to disposition is also ordinary income up to the accrued amount.
Wow. Okay, so the timing of the tax trigger for a discount really depends on why there's a discount, original issue versus market, and then for market discount, it also depends on an active choice, an election you might make. This is, complex stuff.
It definitely has layers.
The source materials also briefly mention something about below-market loans creating imputed interest. What's that about? Sounds theoretical.
It is a bit theoretical, but it's another fascinating example of how the tax code can actually create a taxable event, even when no cash changes hands. Section 7872 deals with this.
Okay.
It applies to loans where the interest rate charged is below what's called the applicable federal rate, or AFR. The IRS publishes these AFRs every month.
Okay, so if I lend money to someone interest-free or really cheap.
Exactly. The IRS might step in and essentially impute interest. They pretend that interest was paid at the AFR even though it wasn't.
Pretend interest was paid? How?
Yeah.
How does that create a taxable event?
Well, the IRS treats the lender as having received that foregone interest, the difference between the AFR and what was actually paid, if anything. That deemed receipt of interest, that's a taxable event for the lender. They have income.
Even though they never got the cash.
Even though they never got the cash. And then, it gets weirder, the IRS then treats the lender as immediately transferring that same amount back to the borrower.
Okay, why?
The tax consequence of that second deemed transfer depends entirely on the relationship between the lender and borrower. If it's an employer lending to an employee, it might be treated as taxable compensation to the employee. If it's a parent lending to a child, it might be a taxable gift from the parent. If it's a corporation lending to a shareholder, maybe a dividend.
Whoa. So the IRS invents income for the lender and then invents a reason for giving it back to the borrower, which might also have tax consequences.
Pretty much.
Why?
The key principle here for our topic is that the imputation of interest creates taxable income, a taxable event, for the lender based purely on the structure of the loan, not on cash flow.
Wow. Okay. That really drives home the point that a taxable event is a legal definition, a creation of the tax code. It's not always just about cash hitting your bank account.
Absolutely not. It's about transactions, positions, relationships, elections. Things the tax code says are significant enough to trigger income recognition.
Okay. That's a lot on interest and related concepts. Let's pivot now to the second major source of investment income you mentioned, dividends.
Right. Dividends, usually coming from owning stocks or maybe mutual funds that hold stocks.
And these typically show up on a Form 1099 DIV.
Correct. 1099 DIV is the main form here.
So what triggers the tax for dividends? Is it just getting the payment?
The classic taxable event for dividends is exactly that.
Huh?
Simply receiving the dividend payment or distribution from the company or the fund.
Okay.
When a company or a mutual fund distributes money, or sometimes even property, to its shareholders, if that distribution is paid out of the company's accumulated earnings and profits, basically, it's retained profits,
Then it's a dividend.
then it's generally considered a taxable dividend to you, the shareholder, when you receive it.
Okay. Now, are all dividends taxed the same way? I feel like I've heard about qualified dividends being better.
Yes. This is a really critical point. The tax rate you pay depends heavily on the type of dividend and, crucially, your holding period for the stock.
Holding period again.
Okay. Dividends generally get taxed in one of two ways, either as ordinary income or as qualified dividends.
And qualified is better.
Much better, usually. Qualified dividends get taxed at the lower long-term capital gains rates, currently 0%, 15%, or 20%, depending on your overall income level.
Wow, okay. And ordinary dividends.
Ordinary dividends get taxed at your regular higher ordinary income tax rate. That could be up to 37% for top earners. The difference in the actual tax bill can be really substantial.
Definitely. So what makes a dividend qualified to get those lower rates?
There are a few requirements. Generally, it has to be paid by a U.S. corporation, or what's called a qualified foreign corporation.
Okay.
But most importantly, for triggering the lower rate, you, the investor, have to meet a specific holding period requirement for the stock relative to the dividend payment date.
There it is again, holding period. How long do I actually need to hold the stock for the dividend to be qualified?
Okay, for dividends on common stock, you generally have to hold the stock for more than 60 days during a specific 121-day period.
That 121-day period, when does that start?
That 121-day window begins 60 days before the stock's ex-dividend date.
Ex-dividend date. That's the date when, if you buy the stock on or after that date, you don't get the upcoming dividend, right?
Exactly. It's the cutoff date. So the window is 60 days before the ex date itself, and 60 days after. You need to own the stock for at least 61 days total within that 121-day window.
Okay. 61 days within that 121-day window. What about preferred stock? Is it different?
It is. For dividends on most preferred stock to be qualified, the holding period requirement is longer. You need to hold it for more than 90 days during a similar 181-day period centered around the ex-dividend date.
90 days for preferred. Okay, let's try a practical example. Say I hear Megacorp is about to pay a really big dividend.
Okay.
And I think, great, I'll jump in. So I buy Megacorp stock just one day before the ex-dividend date. I hold it just long enough to be entitled to the dividend, collect it, and then maybe I sell the stock a week later.
Right. Classic dividend capture strategy attempt.
Yeah. So in that scenario, I receive the dividend payment. That's a taxable event, right?
Yes. Receiving the dividend is definitely a taxable event.
Will it be a qualified dividend taxed at the lower rates?
Almost certainly not.
Why not?
Because you didn't meet the holding period requirement. You bought it one day before the ex date and sold it a week after. That's maybe 8 or 9 days total you held it. Way short of the more than 60 days needed within that 121-day window.
Okay. So even though I got the dividend in cash,
that dividend payment is still taxable income to you, but it would be taxed at your higher ordinary income tax rate, not the preferential qualified dividend rate.
That's a really common trap, isn't it, for people just chasing dividends without thinking about the holding period tax rule?
It's incredibly common. And the IRS guidance, like in Pub 550, has examples showing exactly this. If you buy just before the window starts and sell within it, you fail the test, and the dividend gets treated as ordinary income. The timing of your purchase and sale around the ex date is critical for determining the tax rate applied to that dividend event.
Makes perfect sense. So receiving a dividend payment is always a taxable event, always triggers income. But your holding period around the ex-dividend date dictates how it's taxed ordinary income, or potentially qualified at lower rates.
Precisely.
Okay. Now, what about dividends that aren't cash? Like sometimes a company gives you more shares of its own stock instead of cash, a stock dividend. Is that a taxable event when you get the shares?
Generally, no.
Oh, okay.
Usually when a corporation distributes shares of its own stock to you, its shareholder, as a dividend, it's not a taxable event at the time you receive those new shares. It's typically treated more like a non-taxable stock split.
So what happens then?
You just have to adjust your cost basis. You take the basis you had in your original shares and spread it out over both the original shares and the new shares you received.
So the taxable event is basically deferred.
Exactly. It's deferred until you eventually sell any of those shares, whether they're the original ones or the new dividend shares. The sale is the future taxable event.
Okay, but you said generally. That implies there are exceptions where receiving stock is taxable.
You caught that? Yes, there are exceptions. The IRS has rules to stop people from using stock dividends to avoid taxes unfairly.
Like what?
Well, for instance, if you, the shareholder, have a choice, if the company says you can take the dividend in cash or in stock, and you choose the stock, then the distribution of stock is taxable to you when you receive it. It's valued at the fair market value of the stock on the distribution date.
Ah, so the choice makes it taxable.
The choice makes it taxable. Also, if the stock dividend results in what's called a disproportionate distribution,
Disproportionate.
meaning maybe some shareholders get cash while others get stock, and the result is that the shareholders who got stock end up owning a larger percentage of the company than they did before. If it changes the proportionate ownership like that, the stock received can be taxable.
Okay, that makes sense. Trying to prevent shifts in control disguised as dividends.
Exactly. And there are other technical rules too. Distributions on preferred stock are often taxable. Distributions of convertible preferred stock can be taxable. It gets complicated quickly.
But the takeaway is, in those specific cases choice, disproportionate effect, Suiton preferred stock, receiving the stock dividend itself becomes the taxable event, and it's taxed based on the stock's value at that time.
Correct.
Okay. What about liquidating distributions? The sources mention those too. Sounds like when a company is shutting down.
Exactly. Liquidating distributions happen when a corporation is winding down its operations, either partially or completely, and distributing its assets back to shareholders. These are treated quite differently from regular dividends.
How so?
They're generally considered a return of your capital first, a return of your initial investment in the stock.
So, not taxed immediately.
Not immediately as income or gain.
Yeah.
No. You basically get your investment money back tax-free up to the amount of your cost basis in the stock.
My basis again. Okay.
So you track the total liquidating distributions you receive. As long as the total is less than or equal to your adjusted basis in the stock, it's just treated as reducing your basis, potentially down to zero. No tax yet.
But what if the distributions keep coming after my basis is zero?
Then you have a taxable event. Once the total liquidating distributions you've received exceed your basis, any further distributions you get are generally treated as capital gains.
Ah, okay. So the taxable event for liquidating distributions is effectively delayed until after you've gotten your initial investment back. And then any extra is taxed as a capital gain.
Precisely. The trigger point is crossing that basis threshold.
And would that gain be short-term or long-term?
That depends on your holding period for the stock itself, just like if you had sold the stock on the open market.
Got it. Okay. So, wow, we've covered a lot of ground on taxable events related to receiving income while you hold assets. We hit interest standard, OID, market discount, imputed interest, savings bond rules, and dividends, ordinary qualified stock dividends, liquidating distributions.
Yep. Covered a lot of the ways income flows to you.
Now let's shift gears to that other massive category of taxable events. Selling, exchanging, or otherwise disposing of assets. This is where capital gains and losses really come into play, right?
Absolutely. This is probably the most frequent and often the most significant type of taxable event for many active investors.
Selling stocks, bonds, mutual funds.
Right. Or even things like investment real estate, collectibles, cryptocurrency. When you sell an asset like that for a profit, you trigger a capital gain. And that gain is generally taxable income.
Okay, so the act of selling is the trigger. But you said, if I make a profit, what if I sell at a loss?
The sale is still the trigger event. It's the event that realizes either the gain or the loss that is built up while you held the asset.
Realizes, okay, so if my stock went up in value but I haven't sold it yet?
That's an unrealized gain. It's just on paper in your account value. It's not taxed yet.
Right.
It only becomes a realized gain, and therefore potentially taxable when you actually complete the transaction, when you sell it, or exchange it for something else, or dispose of it in some other way that the tax code recognizes.
Okay, so the sale or disposition makes the gain real for tax purposes. How do you calculate that gain? It's not just the selling price, is it?
No, definitely not. You absolutely need to know your basis in the asset you sold.
Basis again. Okay, remind me what that is.
Your basis is generally your original cost to acquire the asset, what you paid for it, including any commissions or fees you paid when you bought it.
Okay, original cost.
But it's not always just the original cost. Your basis gets adjusted over time for certain things.
Like what?
Well, we mentioned OID earlier. The OID you reported as income each year. That increases your basis in the bond.
Ah, right, to avoid double tax.
Exactly. Or think about dividends. If you participate in a dividend reinvestment plan, a DRP, those reinvested dividends are usually taxable income to you when reinvested. And because you use that taxed income to buy more shares, the amount reinvested increases your basis in your total holdings.
Okay, so basis goes up with reinvested dividends and OID inclusion. Does anything decrease it?
Return of capital distributions, like we talked about with liquidating distributions before they exceed basis, would decrease your basis. Certain other adjustments can happen too. And then when you sell, any selling expenses, like brokerage commissions you pay on the sale, those actually reduce the amount realized from the sale. Or you can think of them as effectively increasing your overall cost for tax calculation purposes.
Okay, so putting it all together, how do I calculate the gain or loss? What's the formula?
The basic formula is your selling price minus any selling expenses, minus your adjusted basis.
Selling price minus adjusted basis equals?
Your capital gain or capital loss.
Got it. Selling price, net of costs, adjusted basis, gain or loss. If that number's positive, it's a gain, potentially taxable. If it's negative, it's a loss.
You got it. That's the core calculation triggered by the sale event.
And tracking that adjusted basis, that sounds like it could get complicated.
Oh, it really can. Especially, like you said, with mutual funds, where maybe you've been buying shares month after month for years at different prices, maybe reinvesting dividends all along. Tracking the basis of each specific share lot can be a nightmare.
Yeah, I've heard people talk about using average basis methods for mutual funds. Does using average basis change the fact that the sale is the taxable event?
No, the sale is still the taxable event that triggers the gain or loss calculation. But electing to use an average cost basis method changes how that gain or loss is calculated.
How does it work?
Instead of tracking the specific cost and purchase date for every single share you ever bought in that fund, which is called using specific identification, you can elect for mutual fund shares and certain dividend reinvestment plan shares to use an average cost. You basically calculate one average cost per share for all the shares you own in that account.
And then you use that average cost as your basis whenever you sell any shares from that fund.
Exactly. It dramatically simplifies the record keeping. When you sell, say, 50 shares, you just use that calculated average cost per share as your basis for those 50 shares to figure out the gain or loss.
So choosing to use average basis, that's like a tax decision itself that affects the outcome of the later taxable event, the sale.
Yes, precisely. It's an election you make. And generally, once you elect to use average basis for shares acquired after 2010, what they call covered securities, you usually have to stick with it for all future sales of shares from that same fund in that same account. And you need to notify your broker you're using it. It directly impacts the gain or loss number calculated when the sale event occurs, which, of course, affects your tax liability.
Interesting. Okay, so selling triggers the calculation. Basis is key. And methods like average basis can affect the result. Now, speaking of the result, the tax rate applied to that capital gain, that depends heavily on something we touched on earlier, the holding period.
Absolutely critical. After figuring out the amount of the gain or loss, the holding period is probably the single most important factor. Why? Because it determines whether your capital gain or loss is classified as short-term or long-term.
And that classification dictates the tax rate.
Completely dictates the tax rate applied to gains.
Okay, how exactly is the holding period measured? When does the clock start and stop?
It's the length of time you own the property before the date you sold or otherwise disposed of it. The general rule is you start counting the day after you acquired the property, and you count up to and including the day you dispose of it.
Day after you buy, up to and including the day you sell.
Okay.
And what's the magic dividing line?
1 year. It all hinges on whether you held the asset for more than 1 year.
More than 1 year. So 1 year and 1 day counts as long-term.
Exactly. If you hold the asset for 1 year or less, 365 days or less generally, any gain or loss you realize when you sell is short-term.
Okay. Short-term is 1 year or less.
If you hold the asset for more than 1 year, meaning 1 year and 1 day or longer, then the gain or loss is long-term.
Why does holding it for just 1 extra day, crossing that 1 year threshold, make such a huge difference for tax purposes?
Because the tax rates are drastically different.
Yeah.
Short-term capital gains are taxed at your ordinary income tax rate.
Which we said can be pretty high, up to 37%.
Right. Same rates that apply to your salary, interest income, ordinary dividends, etc.
But
long-term capital gains get preferential treatment. They're taxed at lower rates.
What are the long-term rates?
Currently, there are 3 main brackets: 0%, 15%, or 20%. Which rate applies depends on your total taxable income for the year.
0%.
Yeah.
Some people pay zero tax on long-term gains.
Yes. For 2024, for example, if you're a single filer and your total taxable income, including the gain, is $44,625 or less, your long-term capital gains rate is 0%.
Wow.
The 15% rate applies for income above that, up to $492,300 for single filers. And then the 20% rate kicks in for income above $492,300. These thresholds are different for married filing jointly, etc.
That is a massive difference compared to ordinary income rates that start at 10% and go up quickly.
Huge difference. Think about it. A $10,000 gain. If it's short-term and you're in, say, the 24% ordinary bracket, that's $2,400 in tax. If you held it just one day longer to make it long-term and you fall into the 15% long-term bracket, the tax is only $1,500. That's a $900 difference just based on holding period.
Wow. It really highlights how understanding the timing impact, that connection between your holding period and the tax triggered by the eventual sale, is just fundamental for any investor thinking about selling something that's gone up in value.
Absolutely fundamental. It's a direct link between how long you held it and the tax consequence of the sale event.
Okay, so selling an asset is the core taxable event for capital gains and losses. Basis determines the amount. Holding period determines the rate, short-term versus long-term. What about selling things that aren't quite typical investment assets? Like, what if I sell equipment used in my business?
That's a different set of rules, generally. Gains or losses from selling property that you held for sale in the ordinary course of your business, like inventory, or depreciable assets used in your trade or business, like equipment or buildings. Those are usually subject to different tax treatment.
Not capital gains.
They might be treated as ordinary income or ordinary loss. Or they could fall under Section 1231, which has its own complex rules blending ordinary and capital treatment depending on net gains or losses from such assets over the year. Our focus here today is really on assets held for investment stocks, bonds, funds, etc., which primarily fall under the capital gain and loss rules.
Got it. Stick to investment assets. Okay, let's look at a few specific ways you might dispose of an asset that aren't just selling it on the stock exchange. What about stock redemptions? Like when the company itself buys back its own stock from me.
Right, a redemption. When a corporation buys back its own stock from you, a shareholder, that transaction is generally a taxable event.
How is it taxed, like a sale?
Usually, yes. The general rule treats a redemption as a sale or exchange of the stock. So you'd calculate your gain or loss just like we discussed. The redemption price you receive minus your adjusted basis in the shares that were redeemed, and the gain or loss would be capital, either short-term or long-term based on your holding period.
Okay, seems straightforward, but I'm sensing there might be an except when.
You're learning the tax code rhythm.
Yeah.
Yes, there is a major exception. If the redemption is considered essentially equivalent to a dividend based on the specific facts and circumstances.
Equivalent to a dividend? How?
Typically, this happens if the redemption doesn't meaningfully reduce your proportionate ownership interest in the company. Imagine a company with one shareholder who owns 100% of the stock. If the company redeems half of that shareholder's stock for cash, the shareholder still owns 100% of the company afterwards, right?
Yeah, their percentage ownership didn't change.
Exactly. In a case like that, the IRS is likely to say the redemption didn't really change the shareholder's relationship to the company. It just looks like a way for the company to distribute earnings, like a dividend. So in that situation, the entire distribution amount could be treated as an ordinary dividend, taxed at ordinary income rates, or qualified rates if applicable, rather than proceeds from a sale eligible for capital gain treatment and basis recovery.
Wow. So the tax treatment of the redemption event, capital gain loss versus ordinary dividend hinges on whether it significantly changes my ownership stake relative to others.
That's the core test. Does it result in a meaningful reduction in your proportionate interest? If not, it risks being reclassified as a dividend. It's a complex area with specific percentage tests the IRS uses.
Definitely sounds complex. Okay, so stock redemption is a taxable event, but the type of event depends on the ownership impact. What about when a bond I own just matures? The company pays me back the face value. Is that treated like a sale too?
Yes. Generally, the redemption or retirement of a bond at its maturity is also treated as a sale or exchange for tax purposes. You'd compare the redemption amount, usually the face value, to your adjusted basis in the bond to determine your capital gain or loss. Though remember, if there was market discount, that part might be ordinary income.
Okay. Now, are there situations where the IRS treats me as having sold something for tax purposes, even if I haven't actually formally gone through a sale transaction? I think the sources mentioned constructive sales.
Yes, constructive sales. This is a really important anti-abuse rule. It's designed to stop investors from doing tricky things, to lock in the economic gain on an appreciated asset like stock that's gone way up while technically still owning it, just to defer paying the tax indefinitely.
How does it work? What kind of tricky things?
The rule applies if you hold what's called an appreciated financial position. Think stocks, certain debt instruments, partnership interests that have gone up significantly in value since you acquired them.
Okay, I own appreciated stock. What next?
And then you enter into certain specific types of transactions that essentially eliminate or substantially eliminate both your risk of loss and your opportunity for future gain on that original stock position. You basically hedge it away completely.
What kind of transactions do that?
The classic examples are things like entering into a short sale of the exact same stock, shorting against the box it used to be called, or entering into an offsetting futures or forward contract to sell the same property, or buying a put option and selling a call option on the same stock with similar terms, a caller if it's tight enough.
Yeah.
The key is that these offsetting transactions effectively neutralize your economic exposure to the original appreciated asset you still hold.
So I've basically locked in my game using derivatives or short sales, even though I haven't sold the original shares. What's the tax consequence then? When does the taxable event happen?
The taxable event happens at the moment you enter into that offsetting transaction.
Yeah.
The transaction that creates the constructive sale.
Right then. Not when I eventually sell the original shares.
Right then. At that instant, the tax code treats you as if you had sold the original appreciated financial position, your stock, for its fair market value on that date.
Whoa.
You have to recognize any gain on that position at that time in that tax year, even though you haven't actually sold the original shares yet and received cash for them.
And what happens to my holding period for the original shares?
It gets reset. Your holding period for that original appreciated position is treated as beginning anew on the date of the constructive sale, as if you had just acquired it that day.
Wow. Okay, so the constructive sale rule essentially forces the taxable event, the realization of the gain, to happen much earlier. It stops you from using these hedging strategies to kick the tax can way down the road on a gain you've already effectively secured.
Exactly. It forces that tax trigger based on the economic reality of having locked in the gain, not just waiting for the legal transfer of the original shares. It's an anti-abuse rule focusing on economic substance over legal form.
That's a powerful rule. Okay, another interesting area mentioned in the materials is something called Section 1256 contracts. What are those and how do they trigger taxes?
Section 1256 contracts. These are a specific category of financial instruments that are typically actively traded. The main examples are regulated futures contracts, like commodity futures, foreign currency contracts traded on the interbank market, and certain types of options, like non-equity options and dealer equity options. They have to be traded on or subject to the rules of a qualified board or exchange.
Okay, so certain futures and options, what's special about their tax treatment?
They have a very unique tax rule called mark-to-market.
Mark-to-market. Does that mean marking their value to the current market price?
Precisely. At the end of every single tax year, you must treat any Section 1256 contracts you're still holding as if they were sold for their fair market value on the very last business day of that year.
Every year, even if I didn't actually sell them.
Every year.
Yeah.
Regardless of whether you actually closed out your position or not, any gain or loss calculated based on that deemed year-end sale value must be recognized for tax purposes in that year.
So that annual valuation and recognition, that's the taxable event for these contracts.
That is the primary taxable event for Section 1256 contracts held at year-end. It's another clear case where a taxable event is triggered by an annual valuation requirement imposed by the tax code, not just by an actual sale you initiated.
Why do they do this for these specific contracts?
The thinking is that these instruments are generally very liquid, easily valued, and often used for short-term trading or hedging. The mark-to-market system prevents the deferral of gains and accelerates the recognition of losses on these highly volatile positions year by year.
Okay. So the tax code forces the recognition of gains and losses annually. How are those gains and losses taxed? Are they short-term or long-term?
This is the other unique part. Any gain or loss recognized under this mark-to-market rule at year-end, as well as any gain or loss realized when you actually do sell, terminate, or offset the contract during the year, is subject to a special rule called the 60/40 rule.
The 60/40 rule, what's that?
It means that regardless of how long you actually held the Section 1256 contract, whether it's for 2 days or 2 years, 60% of the resulting capital gain or loss is automatically treated as long-term capital gain or loss.
60% long-term.
Yes. And the remaining 40% is automatically treated as short-term capital gain or loss.
Wow. So it's a fixed statutory blend, 60% long-term rates, 40% short-term ordinary rates, completely independent of your actual holding period.
Exactly. It's a unique feature just for these Section 1256 contracts.
Okay, so to recap Section 1256, these specific futures and options trigger an annual taxable event based on mark-to-market valuation at year end. And any gain or loss, whether from mark-to-market or actual sale, gets split 60% long-term, 40% short-term by rule.
You've got it. It really highlights again how the specific type of investment you hold can drastically change not only when a taxable event is triggered, but also how the resulting income or gain is characterized and taxed.
Absolutely. Now, we focus a lot on events that trigger income or gains. What about losses? We mentioned that selling for less than basis creates a capital loss. Is realizing a loss also considered a taxable event, even though you're not paying tax on it?
That's a great way to think about it. Yes, selling an asset for less than your adjusted basis results in a realized capital loss. And while it doesn't create income you have to pay tax on, it is a very significant tax event. Why? Because capital losses can be used to offset capital gains.
Ah, so they reduce the amount of gain you do have to pay tax on.
Exactly. That's a crucial benefit for investors. Capital losses first offset capital gains, dollar for dollar. Short-term losses offset short-term gains first. Long-term losses offset long-term gains first. Then, if you have net losses remaining in one category, they can offset gains in the other category.
What if my losses are bigger than all my gains for the year?
If your total capital losses for the year exceed your total capital gains, you have a net capital loss. You can then deduct up to $3,000 of that net capital loss against your other ordinary income, like salary, interest, etc. It's $1,500 if you're married, filing separately.
Only $3,000 against ordinary income. What if my net loss is bigger than that?
Any remaining net capital loss beyond that $3,000 limit isn't lost. It gets carried forward to the next tax year.
Carried forward indefinitely.
Indefinitely, yes. In future years, you can use that carry forward loss to offset future capital gains and again, potentially deduct up to $3,000 per year against ordinary income until the carry forward loss is used up.
Okay. So realizing a capital loss is definitely a significant tax event because it generates a tax benefit, the ability to reduce other taxable income, either capital gains or a limited amount of ordinary income.
Precisely. It's an event with valuable tax consequences.
But there's a catch, isn't there? A big rule about losses that investors absolutely have to know about, something called the wash sale rule. I hear this trips people up all the time.
Oh, the wash sale rule.
Yeah.
Yes, absolutely critical and a very common pitfall. You must understand this if you're dealing with investment losses.
What's the purpose of it?
It's basically designed to prevent investors from generating an artificial tax loss. They don't want you selling a stock or security just to claim the tax loss deduction, only to immediately buy back the very same thing or something almost identical.
Yeah.
If you do that, you haven't really changed your economic position, right? You still basically own the same investment. The rule stops you from getting the tax benefit in that situation.
Okay, so how does the rule actually work? What are the mechanics?
The rule kicks in if you sell stock or securities at a loss.
Okay, sell at a loss.
And within a specific time window around that sale date, you acquire substantially identical stock or securities.
Okay.
Or if you acquire a contract or option to buy substantially identical stock or securities.
Substantially identical, like the exact same stock.
Often, yes, the exact same stock or bond. But substantially identical can sometimes be broader, though the IRS is pretty strict. Buying shares of the same company is definitely identical. Buying an option on that same stock counts. Buying shares in a different company in the same industry probably isn't identical. Buying an ETF tracking the S&P 500 might not be considered substantially identical to selling shares of another ETF that also tracks the S&P 500. But it's a gray area you need to be careful with.
Okay, stick with the clear case. I sell stock XYZ at a loss. What's the time window I need to worry about for buying it back?
The window is 61 days long. It covers the 30 days before the date of the sale that created the loss.
30 days before.
Yes, plus the day of the sale itself, plus the 30 days after the date of the sale.
So a 61-day period centered right on the sale date. If I buy substantially identical securities anytime within that 61-day window,
Then the loss you realized on the sale is disallowed for tax purposes in the current year. You cannot deduct it.
Okay, so let's say I bought XYZ stock at $50. It drops to $40. I sell it today, realizing a $10 per share loss. If I then buy XYZ stock back next week, which is well within 30 days after the sale,
that $10 per share loss from your sale today is disallowed. You can't use it to offset gains or deduct it against ordinary income on this year's tax return. The repurchase within the window triggered the wash sale rule.
so the sale was still a realization event, a taxable event in that sense.
Oh.
But the tax benefit of the loss triggered by that event is denied for now.
Exactly. The loss is realized, but its deductibility is suspended due to the wash sale rule being triggered by the repurchase.
What happens to that disallowed loss? Does it just vanish? Do I lose that tax benefit forever?
No, thankfully it's not lost forever. The disallowed loss is deferred.
Deferred how?
It gets added to the cost basis of the new substantially identical stock or securities that you purchased within the 61-day window, the purchase that triggered the rule.
It increases the basis of the replacement shares.
Correct. So in your example, you sold at $40 for a $10 disallowed loss. You bought back in next week, let's say at $42 per share. Your cost basis in those new shares isn't just the $42 you paid. It's $42 plus the $10 disallowed loss for a total basis of $52 per share.
I see. So because my basis in the new shares is higher, $52 instead of $42, when I eventually sell those new shares in the future.
Your taxable gain will be smaller if the price goes up from $42, or your taxable loss will be larger if the price goes down further by exactly the amount of that previously disallowed $10 loss.
Okay, so the loss isn't gone. It's just sort of baked into the basis of the replacement shares, and I'll get the tax benefit later when I sell those shares.
Precisely. The tax benefit of the loss is effectively postponed and tied to the ultimate disposition of the replacement shares that caused the wash sale in the first place. It preserves the loss economically, but denies the immediate tax deduction if you haven't truly exited the position.
This is incredibly important, especially for people doing tax loss harvesting, right?
Yeah.
Where they intentionally sell investments that have gone down in value near year end to generate losses to offset gains they've realized elsewhere.
Absolutely critical for tax loss harvesting. If you sell stock A for a loss, hoping to use that loss, you absolutely cannot buy stock A back within 30 days before or after that sale.
So what do people do if they sell for a loss but still want to be invested in that sector or type of asset?
They have two main options to avoid the wash sale rule on that specific security. One is just wait. Wait at least 31 days after the sale before buying back the same security. That gets you outside the 61-day window.
Okay, wait, 31 days. What's the other option?
The other is to buy a different security immediately. One that is similar in investment profile, but hopefully not considered substantially identical by the IRS. For example, selling an ETF tracking one broad market index and immediately buying an ETF tracking a slightly different but correlated index. Or selling one large cap growth stock and buying a different large cap growth stock. There's some risk here depending on how similar the investments are, but it's a common strategy.
Got it. So understanding that wash sale rule, that 61-day window, and the definition of substantially identical is absolutely essential if you're trying to manage your taxes by realizing losses. The sale at a loss is the initial event, but it's the repurchase within the window that triggers the disallowance and the basis adjustment.
Perfectly summarized. It's a two-step process to watch out for.
Wow. Okay. This has been incredibly detailed. We've really gone through a lot of the specific actions, the specific moments in time that trigger some kind of tax obligation or tax consequence for U.S. investors.
We've covered quite a few.
Yeah, everything from receiving different kinds of interest standard, OID, market discount, even that weird imputed interest, and all the flavors of dividends, ordinary, qualified, stock dividends, liquidating ones, then moving to the big one, selling or disposing of assets, which is what realizes gains or losses, and how crucial basis and holding period are for calculating the tax on that event.
The core gain-loss realization event.
And then we hit those special rules like constructive sales, forcing a realization event early, the mark-to-market requirement for Section 1256 contracts triggering annual events, and of course the critical wash sale rule that affects the treatment of a loss event.
They're all distinct triggers, distinct events in the eyes of the tax code. But you're right, they share that common thread. They are the specific points in time or the specific actions that the IRS identifies as requiring you, the investor, to recognize income, gain, or loss on your tax return.
And I guess the point isn't that you can magically make these taxable events disappear if the rules say they happened.
No, you generally can't avoid tax legally due just because you understand the trigger. If you sell for a gain, you owe tax on the gain according to the rules.
Right. But understanding when and how these events get triggered, that feels really empowering.
It absolutely should be, because knowledge is power here. Understanding the triggers allows you to anticipate your potential tax liabilities. That's just fundamental for sound financial planning, right? No surprises.
Yeah, definitely.
It might inform the timing of your actions. Maybe you realize you're close to the one-year mark on an appreciated stock. Holding it just an extra week or two could turn a high-tax short-term gain into a much lower-tax long-term gain. Understanding the trigger helps you make that informed decision.
It also really highlights the need to track your basis accurately. All those calculations depend on it.
Meticulously.
Yeah.
Especially with reinvestments or stock splits or return of capital. Bad basis records mean incorrect gain-loss calculations when the sale event occurs.
And it makes you aware of those potential traps, like the wash sale rule if you're trying to harvest losses. You know what to avoid.
Exactly. And maybe most importantly, it helps ensure you accurately report all your investment activities to the IRS on your tax return. Knowing what's taxable and when helps you file correctly and avoid potentially costly mistakes, penalties, or audits.
So this deep dive, it really gives you that foundational knowledge of what actions actually trigger taxes on your investment.
That's the goal, to map out those triggers.
But as we always say, this isn't personalized tax advice, right? The actual application of these rules, it depends so much on your individual situation.
Oh, absolutely. Your specific income level, your filing status, what other investments you have, state tax rules, it all interacts. This discussion gives you the map of the general landscape, show you the different triggers we talked about.
But navigating that landscape optimally.
For your unique circumstances, you really should consult with a qualified tax professional, a CPA, or an enrolled agent who understands investment taxation. They can help you apply these general rules to your specific portfolio and your overall financial picture.
Yeah, that makes total sense. Use this knowledge as a foundation, but get personalized advice.
Exactly.
This whole discussion has really hammered home for me how interconnected every single investment decision is with its potential tax consequence. It's not just about picking the right stock.
It really isn't. Every action you take as an investor, buying, holding, and receiving income, selling, exchanging, even hedging, it casts, as you called it earlier, a tax shadow.
A tax shadow. I like that image. It makes me wonder, what does truly being a well-informed investor even mean if you're not also thinking about that shadow?
That's a great question to ponder. I think it means understanding that your real return, your net return on your investments, isn't just the gross gain or the income generated. It's what's left after taxes are paid.
Right. The bottom line after the IRS takes its share.
So being well-informed means factoring those potential tax implications, understanding the triggers we've discussed, into your decision-making process before you act. Planning accordingly, rather than just reacting with surprise when the tax bill comes due.
Thinking about the tax consequences as you make investment decisions, not just afterwards.
That's the key. Recognizing the triggers and planning around them.
That is definitely a powerful thought to leave with. Well, thank you so much for walking us through all of this. This has been incredibly enlightening.
My pleasure. It's complex stuff, but hopefully breaking down these specific taxable events helps everyone approach their investment journey with a clearer understanding of these really crucial tax triggers.
I'm sure it will. Thanks again, and thanks to all of you for listening to this deep dive.
Thanks, everyone.
We'll catch you on the next one.